Hi folks, this is Sean Hyman from Chart of the Day, and I just want to talk to you about trading the pre-interest rate calm. And what do I mean by that? Let's take a look here, and I'll show you what I mean. In the market, before you have large moves, like and these will happen before you have large economic announcements. For instance, here's one where we've got Australia, and they're about to come out with a interest rate announcement at 10:30 p.m. Eastern Standard Time as I'm filming this. So so it hasn't come yet, and by the time that you see this, it'll have already come. But what we're talking about is the pre-interest rate calm. In other words, the period that happens before the rate announcement. So that's what makes it relative that you see what's going on right now before the interest rate announcement. And I've got a 15-minute chart up of Aussie yen because it's an Aussie interest rate announcement that's coming up. And I've gone back a few days in time. And the interest rate hike there's an interest rate hike expected to go from 3.75% up a quarter point to 4.00%. And so whether that hike happens or not still remains to be seen, but many of the traders, it looks like, are trading this thing higher, as we can see here, as shown in the green uptrend line here. So how you trade the pre-interest rate calm is you would look at your trend bias first, which is upward, and the expectation for rates are higher, so that would embrace buying as well. And because money would be headed towards a higher interest rate currency, which in this case would be the Australian dollar. And so what you would do is look for buying opportunities when the bottom Bollinger Band is hit. That's these yellow lines that are hit here. So what you do is you wait for the bottom band to be pierced, and then for the pair to come back into the pair right there, into the bands right there. And so it comes in here, so we buy, and then when it hits the top band, we sell. So right there. It hits the bottom band and comes back in right here and comes close to the top band. One could sell here, comes out and then back into the band here. We could sell here, and then we wait because all through here we don't get the bottom band touched. It comes close here but not quite. Then we get our next band touch here and comes back in, so we buy here, comes back out here, and so we sell, and so forth. When we've got, that's not quite a touch there, there's a touch here and it comes back, so we'd buy here and wait for the next move upward again. And so you can see this is a conservative way to trade calm ranges. In my currency cross trader service, we tend to trade strong trends, and we do that because we're going for big swing trades, and we're going for big wins over days and weeks, and the trend trades give you a huge edge. And so, but this is a way that you can go for fairly near-term, fairly safe, controlled ranges, controlled trades. I wouldn't exactly say a range because I mean it's actually a very mild trend, but it's a very controlled move, and it's the biggest thought behind this is that there's not apt to be a trade that just comes and just takes off and runs away from you. Why is that? Because the big money tends to not put on trades the couple of days or so before an interest rate announcement. And so since the big interbanks aren't placing their ultra huge positions, there's a good chance that the market calms down and the market doesn't run off and leave you. And so that's why you can use something like a Bollinger Band, which is a rangy type of strategy that is typically employed with Bollinger Bands. You get a higher statistical probability by taking the purchase of the band that's with the trend, which is upward. So buys in this upward trend instead of selling short in a downtrend. We wouldn't want to take any shorts because the trend is up, so we wouldn't want to short at the top band, but we would want to buy at the bottom band and sell to close out that buy at the top band. But it's just a fairly neat, fairly low risk, if you can say that in the currency market, a lower risk trade as opposed to many other styles of trades. And you'll get weeks like this week where there's a lot of interest rate announcements. You'll get several throughout the week, and it's a good time to put on this pre-interest rate calm hat and kind of think in those terms, because it can be kind of a dull week before rate announcements, and then it can be any man's guess after the announcement as to how the market will react to the announcement, depending on the outcome, which is unknown until it's released to everyone. And so the best way to play that is to play what is known ahead of the announcement rather than the unknown after the announcement. And the known ahead of the announcement, in other words, before the announcement, is that the markets are likely to be calm and controlled, either trends or ranges. If they're trends, they're still usually going to be mild. If they're trends, you want to see what direction that trend's heading in and trade in the direction of that trend. Use a shorter term chart, like a 15-minute chart. Put your Bollinger Bands on there at this 20 and 2 settings, which are just your typical standard settings for Bollinger Bands. And let the price go, down below the Bollinger Band, come back in the band and buy and sell at the top of the band. It's that simple. You got to be patient, because you will have periods like this where you don't touch the band, but that's okay. Don't be discouraged there. Just be patient and sit on your hands until you get one to where it touches the bottom band again and then heads higher. And so these are trades that you'll typically be in for hours, but not days. And from the point at which you enter, and you'll typically get 3 or 4 or 5 good trades over a 2 to 3 day period, where you can snatch anywhere from 10 to 30 pips per trade. And also, when you're in your calm controlled periods, since the market is less apt to run away and break out and do crazy things, you can tend to trade just a hair larger in lot size than you normally do in regular times. And this is the only time I would say that it's in these calm times. So when the market volatility becomes lesser, you can increase your lot size just a little bit and increase the potential gains in your account, since these are more controlled moves here. So in between currency cross trades, in our currency cross trader service that I'm issuing, you can use things like this to extract small amounts of profit that are fairly lower risk in relation to a lot of the more aggressive strategies in the currency market. And it gives you a way to play something in between trades, or if you're wanting to have on an additional trade over and above what I have for you in the currency cross trader service. Hey, thanks so much for watching. Bye bye.